And with that, we'll kick off the substantive portion of today's program. I thought it made sense to have Paul start out and maybe help us put crowdfunding into perspective. What is equity crowdfunding, as opposed to, Paul, what people sometimes mean when they say crowdfunding, and why is it so novel? How does it fit in the regulatory regime of raising capital?
Sure. Thank you, Larry, for that introduction. One quick thing is it's the crowdfundinglawyers.com plural, so it makes me look bigger than what I really am. But so crowdfunding, when people hear crowdfunding, they think of a lot of different things, and there are obviously a lot of different models to crowdfunding. There's sort of a donation model. There's the Kickstarter model that most people are already familiar with, where you're pre-ordering a product that may still be in development stage. And the latest and most professional version of crowdfunding is what we're going to talk about here today, which is equity crowdfunding or investment level crowdfunding, where retail investors, everybody throughout the country, all 330 million of us, can become early stage investors in companies. And this had not happened until the Jobs Act of 2012. Before that, it was really a closed system, open only to accredited investors. There were some very minor exceptions to that, but for the most part, it was private investing, pre-public company, pre-IPO investing was closed off to accredited investors. And that is still the vast majority of the private capital markets. But Reg CF, or regulation crowdfunding, which was Title III of the Jobs Act, is gaining. And it has had a really good run here, especially in the last few years, last couple of years with COVID, and people started to invest more online, and also just a greater general awareness of it. And so the sort of the revolution here, if you will, that Title III of the Jobs Act, Reg CF did, was it allowed everyone to become investors, as I said, in these companies within the rules that were set by the Securities and Exchange Commission that went live in 2016. So there is a legal form that has to be filed with the SEC. There are limits for the issuers and how much they can raise. There are limits for the investors. There are, as Mariel will talk about, there are certain portals or platforms where the investment can go through. But I'll just sort of give some quick numbers before I pass it off, Larry. Year over year, 22 investments are up 22%. Offerings are up 22%. Investment is up 93% from this time last year, and the number of investors are up 22.3%. So we can get into the details of anything I mentioned here, but that's sort of a general overview of how Reg CF came about and where it's, the good things that are happening since then.
Very, very helpful. And before we turn it over to Mariel, who will hopefully sort of shed some light on some of those statistics, Paul, you talk about Reg CF and crowdfunding as if it's a revolution, and it was revolutionary. It started in 2016. As much of it as it was revolutionary, there was also a little bit of, let's sort of dip our toe in the waters. And with the success of crowdfunding and the lack of rampant fraud in the crowdfunding area that I think some of the opponents or the naysayers may have had, even after the Jobs Act, there was more recently some more opening up of crowdfunding. You want to talk about very briefly the recent rule changes, and then we'll sort of level set us going forward.
Sure, absolutely. And as you said, Larry, the political branches were basically on board with this from the start. This was a bipartisan effort in Congress. It was signed by President Obama. But there was a lot of hostility at the Securities and Exchange Commission against this. And they sort of, as this has progressed and has, as you said, there's been one sort of fraud case that's sort of in progress right now, but that is certainly an outlier. There has been, it has been overall definitely a success story, and the SEC sort of recognized that and kind of came around to that, and in last November passed a lot of a lot of amendments to Reg CF that allowed just a lot more freedom and the ability for issuers or companies to communicate their raise even before the raise, called testing the waters. They cleaned up some of the things with the messy cap table problem that had been an issue from the start. Now, all of the investors can go in one legal bucket on the cap table through a special purpose vehicle. They raised the limits for accredited investors. Now have no limits. That's very important to bring in a big investor, or ideally more than one, to this raise, to sort of show that this is that your particular raise is a serious raise. The other investors also had higher limits. And so all of these things have come together, and then the overall offer limit was raised from 1.07 million to 5 million. And all of these things have come together to really make it a force in the startup community, and something that, if you are a potential company looking to raise money, raise capital, you should really take a look at this as part of your capital raising strategy.
That's great. Very helpful, Paul. Thank you. And Muriel, maybe we'll turn it over to you now. If you've got some of the WeFunder and sort of crowdfunding community statistics that you want to share with us in terms of what's happened, recently, while people have been, stuck in their basement looking for investments, among other things.
Yeah, for sure. Well, Paul honestly just said it so comprehensively and so perfectly. And I think just to add even just more color and another layer to that is to realize, kind of embedded in what he was saying, is just how new this all is also, and how it's literally evolving still year to year. It's not like we lobbied Congress once to make it happen and now it's perfect. It is a continual process, and we're always excited for what is the next update going to be. Because as much as the March 15th update to the rules was amazing and an absolute game changer and literally doubled the revenue that WeFunder at least was doing, and I'm certain that most of the other crowdfunding platforms as well are doing, there's still so many limitations still, and provisions that we're just constantly trying to work, lobbying the SEC, trying to make those changes happen. And so what's exciting about that is we clearly have the power to change it and keep improving it. And that shouldn't in any way diminish the fact that, as Paul said, March 15th of this year, the SEC update was probably, since it became legal in the first place, right, in 2016, March 15th of this year was probably the most important day for the industry in terms of both, accessibility, making, allowing for unaccredited investors to invest even more and expanding that limit. And as Paul said, allowing founders to raise even more capital. So prior to March 15th, for example, with that limit being $1 million, we were mostly seeing pre-seed and seed stage companies. We've just helped companies like Mercury Bank, for example, in their Series B. They allocated a portion of their round. They did the full 5 million, and I think even went over because we can support Reg D as well, as a part of their greater Series B. And so one of the really exciting changes that we've seen since then is founders, taking more of this holistic approach and coming to us from a later stage where they're raising from institutional investors, from VCs, and then supplementing that with equity crowdfunding, with a raise on WeFunder as well. And, coming to us at the Series A and even B stage, as opposed to simply the pre-seed and seed stage, which should be exciting to investors, because that's, if they've made it to Series A, Series B, that's probably, de-risked a little bit. It's a much bigger company. It really offers a wider range of options to investors. So this is just me fangirling over the rules, but really kind of, doubling down on what Paul said about, yes, things are changing in real time. Just 4 years ago, or even 2 or 3 years ago, if you had 800 investors, you had 800 lines on your cap table. That was terrible. There were still founders who were coming to us because they really believed in the mission of democratizing access to investment. And they really wanted, the people who they celebrated with at exit to be their family, their friends, their community, their customers. But it was definitely not the best solution. And so now, thank goodness, as Paul mentioned, with, SPV being able to roll everybody up into one line on the cap table, at least at WeFunder, we also have a lead investor structure. So you don't have to worry about 800 signatures at exit. You don't have to worry about 800 people voting. You work with one trusted strategic lead investor the way you would when you're raising any kind of venture or angel round. And since inception, So I guess we started in 2012, but obviously, the SEC, FINRA didn't really put out the regulation until 2016. Since then, at least on WeFunder, founders have raised over 350 million. I think there's been more than 5 billion raised in capital from those founders after WeFunder. I think we have 1.3 million or so investments, and we find that the median investment is $250, the minimum on WeFunder being 100. So really seeing just like the breadth of investments. It's so amazing to be able to see, and I'm sure all the equity crowdfunding platforms see a similar thing, investments ranging all the way from $100 to like 50K. That's something really normal to see on the back end. And it's beautiful to see just like the democratized access.
Terrific. Very, very helpful. I'm going to ask you a few follow-up questions, and then we'll bring Gary in and we'll loop back, because you said lots of things that I think our audience will have questions about. You mentioned Series A, Series B. Outside of the crowdfunding world, when we're helping our clients raise capital, we're selling common stock, we're doing preferred stock, Series A and Series B. We're doing seed financing that might be a pre-Series A and a Series AA, and then of course convertible notes and safes. What sort of instruments can be sold on the crowdfunding platform, and what do you see as most common?
Yeah, for sure. Great question. So it really actually, this is one of the biggest differentiators between the different platforms. So I believe the top three platforms in order of size, and always like kind of dancing around a little bit, are WeFunder, followed by Start Engine, followed by Republic. Republic offers a crowd safe, which is a safe, but that doesn't convert whatsoever until exit. Start Engine, I believe, lets you raise on any terms, but they also offer the ability to raise common stock, and they do Reg A plus as well. And I actually think Republic does Reg A plus as well. We do just Reg CF and Reg D. We don't do Reg A plus, and we only allow for preferred stock simply because we found that that's what investors want the most. And that's often like the best deal for investors. And we really pride ourselves, at least at WeFunder, on being able to allow founders to raise on literally like any terms that they want, whether they want to do a convertible note, whether they want to do a safe, whether they want to do a priced round, if they want to do a custom note. Obviously, everything's vetted by our team. But the only time we intervene is if we think that they are raising on terms that are going to screw over their investors and no one will invest in, or where they're going to screw over themselves and they're actually not being like at all favorable or kind to themselves in their offering. The final thing we also offer that is unique to WeFunder, and that I'm like just really proud and happy about, is we also offer the ability not just to do equity raises, but also to do debt raises. So you can raise a community loan through a revenue share on WeFunder as well. And so, if you're a small business, I literally last night went to dinner at a restaurant here in San Francisco that is opening a second location and is currently raising on a revenue share on our platform from members of the community. So, you don't just have to be like a high growth startup, to be raising, at least on WeFunder. We also work very closely with small revenue generating businesses.
Terrific. Thank you. And like I said, we're going to come back. We're going to put lots of pins in there. But why don't we bring Gary into the conversation? Gary, me and Paul and WeFunder, we're lucky enough to be involved in your crowd raising, and next we're also lucky enough to be involved in your crowd fundraising. If you can talk a little bit about what brought you to crowdfunding, your crowdfunding experience, and maybe comparing your crowdfunding experience to your non-crowdfunding experience. And if you forget any of those questions, I'll prod you at the end.
Okay.
Thank you.
Great.
Thank you.
Thanks, Larry. So yeah, Neighborhood Sun is a community solar company, and we are a mission-oriented company. So we're a B corporation, and as part of that, just as a CEO, I philosophically really was drawn to the idea of democratization of investment, because that's what we're doing in solar. With community solar, is the same thing. It's democratization of solar. So we were looking to do a crowdfunding just to kind of dip our toes in and see how it would go. We did review several platforms, including the other ones that Mariel mentioned, and we chose WeFunder because they offered the best deal. They were also a mission-oriented company like us, and they had other mission-oriented and clean energy companies on their platform, and they were very easy to work with. So for us, equity crowdfunding, it really fits our brand as a people-powered kind of business. bringing energy democracy, we also wanted to bring financial democracy. It fit our need at the time. So we had just finished up a small Series A. We had previously done angel rounds where we raised about altogether close to $2 million. We were at that point too small to really get VC notice, even if we wanted it. But we were getting a little too big for some of these angel groups. We would go to them and we would say, try to raise money, but our valuation at that point was a little too high for them. So we're in this kind of in-between area where crowdfunding fit in perfectly. And then it has additional benefits for us that we were excited about, building our brand in other markets. We are Maryland based, but we did get investors from, I think, all 50 states except for one. I can't remember which one it was, but a lot from California, New York, New Jersey, all over the country. And that for us was a benefit beyond the investment. As we look to expand into those markets, it could bring us new customers. Finally, I felt like we had a good chance of success because of the kind of company we were, because we already had a customer base, because we had very excited investors who were already with us, and because I knew my team. We're a small company. We were, I think, like 9 or 10 people at that time, but I knew the team would be very excited about it, so we would get all behind the effort. And I do have to say, we worked with Next and with Paul, and you guys made it super easy for us. That was one of the challenges as an entrepreneur. You'll find that you'll talk to some of the suits or the people who run VCs, and they will try to dissuade you from going the crowdfunding route, saying it's complicated, I don't know, all kinds of reasons why they don't think it's good. I don't think they like it because it's competition to them. But having a legal team that made it very easy to do and not complicated also helped me to convince my board and our investors that this was a good way to go.
That's terrific, Gary. What a vote of confidence for sort of the method of raising capital. In terms of, Gary, the process, would you maybe 1 or 2 data points in terms of the speed of raising capital on a crowdfunding platform versus raising it through either whatever your friends and family round was or the AA round? How would you compare the time frames?
Well, the prep work I found it fairly straightforward, but that's because I've been around the block a few times. If you're a brand new entrepreneur, you might be intimidated by the Form C, the legal form you have to fill out. I believe you have to have a financial audit now. I'm not 100% sure, but we got a financial audit. So there's a few things you have to do in prep that you really want to take the time to get it right. But having said that, it's a lot easier than the prep you do for a Series AA or a more institutional round. And then the time frame, it was very quick for us. Now it depends again on how much you're looking to raise. Like right off the bat, we got our $50,000 in, which was what WeFunder had advised us would be a really good way to kick off the campaign, already raising $50,000. I thought we were going to raise $100,000 in total. So I was like, okay, so we're halfway there. And we very quickly got to 100,000. And if I would have been happy, I could have pulled the plug at that point and said, we're done. And that was like a month or 2. It was very quick. But we were so excited. We kept at it. And we eventually did actually raise $1 million. So now that did take us a little bit more time than otherwise would have happened. But overall, I'd say it's a similar time frame. And if you're really looking for a quick hit, you can get a quick hit with crowdfunding if that's what you want.
That's good. Very helpful. So Miriam, let me pick up on one of the things Gary mentioned, and maybe he euphemistically said that WeFunder advised us to have $50,000 before we started. What is that? Is that a WeFunder policy? Is that advice? Is that SEC rules? I mean, where does that fit in, and what is it?
Yeah, great question. So WeFunder has a platform minimum of 50K. That's like the minimum you have to raise as a company to stay on the platform. And so the way that we do that now, as Paul started to mention, one of the new SEC regulations is this ability to do what's called testing the waters, which basically means, prior to March 15, you had to file the Form C and get your financials in order before you could even start sharing the link to your raise. Now you can start sharing that link very widely, collect soft commitments and reservations. And so we ask that you get to at least 50K in that reservations phase to make sure, both on our end, that you can get to at least our platform minimum, but that also allows founders to do two things. The first is to just get started without any upfront cost, without any upfront work. If you can just put a really good pitch together and you kind of know roughly what your terms are, or ideally you already have your terms solidified, you can start gauging interest right away without any kind of barriers. And it's also, the same way that it's a good kind of gauge for us to see if the founders are going to be a good fit for WeFunder and this method of fundraising. It's also a really good way for founders to see okay, were we right about how much interest there is in investing in us? Is this actually going to work out? And to really start to get their feet wet and start to kind of, build up that momentum, such that, as Gary was mentioning, when they do cross 50K and they do now have a raise that is publicly discoverable and just, discoverable organically on WeFunder, people aren't coming to the page and seeing the number 0. They're coming to the page and they're already seeing 50K, which just works to the founder's advantage. The more money that people see you're raising, the more momentum you have behind a campaign. As much as we hope that investors are just doing very holistic and deep diligence, that in and of itself is still, really affects investor psychology and gets them excited about the potential of a raise. The one thing I also wanted to mention that I wanted to correct quickly is, part of the Form C filing, which every platform will do on behalf of the founders, requires two things. First is just filling out simple legal disclosures, as I'm sure Gary went through on the back end, which is just, who are the officers? How much equity do you have? How much do you want to raise? What's the minimum, the maximum? How would you use those funds? Who's the lead investor? Simple, straightforward things like that. And the second component is we just need companies' financials, and this is all, what the SEC requires. If you want to raise up to 250K, the SEC just needs the last 2 years of your financials. If you want to raise 250K to $1 million, we also need a CPA review of those financials. And anything over $1 million requires, or 1.07 million, very pedantically and specifically, over 1.07 million requires an audit of those financials. But those don't need to be completed, at least at WeFunder, until you see that you're close to at least our platform minimum. And that's when we get the legal ball rolling to make sure that it's, worth it for us and worth it for the founders as well.
Terrific. I know Gary mentioned a couple of things. One was sort of how crowdfunding fit into the business philosophy of Neighborhood Sun and democratizing fundraising the same way sort of crowdfunding was democratizing capital raising, as well as a brand building exercise for potential customers. Is there a type of company that is better suited for crowdfunding, along the lines of Neighborhood Sun, or is it really anybody?
Yeah, I think there's this misconception that you have to be consumer facing and you have to be almost like a Kickstarter, like consumer facing product, CPG, direct to consumer type of company in order to be successful on an equity crowdfunding platform. And we found that actually isn't the case. We've worked with healthcare benefits companies, like Zenefits raised with us. We work with deep tech companies, biofuel for space shuttles, Neighborhood Sun, literally anything and everything across the board. What we found resonates most with investors, though, is, and what I'm going to be in a roundabout way describing Neighborhood Sun, but they love anything that has, investors tend to love anything that is socially impactful. So anything around, for example, Neighborhood Sun, it's, the future of solar. It's incredibly impactful. It's also an exciting new technology. It can be classified as deep tech or sustainable technology. And something that we've also seen that's, nothing's a silver bullet here, but something that we found is really, really powerful is when companies are raising with some sort of a geographic or location-based focus. So for example, the fact that Neighborhood Sun is primarily starting in Maryland and just mid-Atlantic Northeast, that really mobilizes investors who can, they're oh, this is where I live, this is something I can relate to. We've really found that like community interest and like, anything that feels local, like for example, with the space biofuel company, they're based in Maine. And I think like half of their investors ended up coming from Maine just because of the potential for economic development and the excitement around that. But genuinely overall, it's less about the features and attributes and characteristics, of a company itself, although, being impactful in some way, having some sort of exciting or proprietary technology in some way is always good. But what genuinely matters the most is like, are the founders able to create a story that just makes what they're building accessible, digestible, and exciting to investors? We have what should be almost like boring or like run of the mill, not boring, but just like straightforward, almost like SaaS companies raising. And you're like, why would an investor who wants like impactful companies, exciting companies invest in just software? But it's really the founder's ability to almost like educate investors on like, hey, here's an entire industry that you might even not be aware of is like booming right now, but here's how it's exciting. And so part of what we do also at WeFunder is we're really, really hands-on like with the storytelling aspect for all companies, because if you're able to articulate what you're building and you're able to kind of generate that excitement and really use it as an opportunity to like educate investors and get them excited about what you're building and about your industry, that's when we really see like investors getting mobilized and excited about what people are building.
Interesting. That's fantastic. Another thing that Gary mentioned was that, as he was going through the process, which I think is something Paul and I also heard, it used to be that people would say, you don't want 800 people on your cap table. Crowdfunding is not the way to go. And I know you've referred to a couple of things that maybe we can expand on a little bit. Paul referred to, and you spoke about some of the more recent amendments, and you've used the word lead investor and SPV. Maybe you and Paul could sort of put that in context and explain, what that is and how that solves the problem and how it and what problem it solves.
Sure. So there are basically kind of two ways. The way that Gary went with the sort of the custodian model, which was what WeFunder was offering at the time, and then sort of what I would call the public or the legal model that was part of the March amendments that we keep referencing. The special purpose vehicle basically allows all of these investors to go into one legal bucket on the cap table, and this is extremely helpful for later rounds and for some of the friction that companies may run into after they do a crowdfunding round. These sort of larger investors or institutional investors don't want to have to deal with a bunch of little guy investors. This makes things much cleaner. And as Mariel alluded to, there's a proxy element there. So there are not a bunch of individual signatures to collect or things like that. And so this was something that the crowdfunding industry had wanted actually from the start, and it only came about because through these amendments there was some legal changes that had to do with the SEC. But this is something that I think has been a very popular amendment to regulation crowdfunding, and it's made it a lot easier. And I'm sure we're going to talk about some ways that they can make it even more easy for the lead investors and for the people who are the ones responsible for the proxy and responsible for the paperwork. But this is just a cleaner way to do this, and it makes it a lot smoother once you go on to those later rounds with those institutional type investors.
Yeah, and just to add to that, one of the biggest reasons why like VCs or institutional investors today still maybe have like qualms or anxious about Reg CF is because they actually don't know that it's just one line on your cap table. Still, they're used to kind of like the old world of equity crowdfunding, which like was genuinely like a mess in so many ways and wasn't, incredibly just not nearly as founder friendly as it could be. And so a lot of what we find we do at WeFunder, and which is why, I come on panels like this, and genuinely so much of my time is spent talking with institutional investors and just educating and like spreading the word and like letting them know, like, no, actually this problem that you think still exists has actually been solved for. But again, this all goes to the fact of, this is still like a super new, it's still like, every year it's changing and it's growing kind of industry. And so a lot of the work that, the platforms like WeFunder, Republic, Start Engine, et cetera, I think like have to do is just spread the word both to founders so they know that it's an option and they know that it's not going to screw up their cap table, but also to institutional investors to make them more comfortable investing alongside a Reg CF round. We've actually, in a really exciting turnaround, we have VCs who come in as the lead investor on WeFunder. We work with really amazing like angel syndicates as well to be the platform for their syndicates of non-accredited and accredited investors to invest. And so slowly but surely, we're starting to establish those relationships because we've never been like anti-VC, but we just fundamentally believe that, VC shouldn't be the only option. And so finding ways to really like work together in harmony, synchronously with institutional sources of institutional capital is definitely a really, really important priority for us.
Great. And then Mariel, one last question, then maybe we'll turn it over to Paul for some more of the nuts and bolts. You've alluded to a couple of times, either Regulation D or accredited investors. How is following the recent amendments that you mentioned? How does accredited investors play into crowdfunding and a possible way to avoid either the individual investor limits or the overall raise limits?
Yeah, for sure. So two things there. Yeah, first of all, we see, as I mentioned before, a really just like healthy and balanced mix on everybody's kind of like back end of both accredited investors with larger checks and non-accredited investors. This really great mix of somebody's mom, somebody's friends, like the customers of a company investing a few hundred, maybe a few $1,000. And we see founders also bringing on angels who they're talking to, who don't necessarily care about having their own line on the cap table, who are investing on the same terms anyway, and looping them into the SPV as well. And we like take away our fees for checks over 25K that come through WeFunder because we want to be able to incentivize, those angels, those accredited investors with the larger checks who often, if somebody's giving you 25, 30K, it's probably also, strategic beyond just like the money ad. And so we really want to be able to, support that as an option. When we talk about Reg D, one of the ways, for example, what Mercury Bank did, Mercury Bank raised like $17 million in 5 days. The limit for Reg CF is 5 million. But what they've done is basically they filled up their Reg CF line on the cap table with $5 million worth of just non-accredited investors. And then they started a Reg D in parallel where they basically ported over all the accredited investors, or as many as, confirmed and could fit in, into a separate line on the cap table. So that is both one way. So Reg D we find is used both to kind of like, skirt those limits a little bit and still, be able to raise in Reg CF, but not have to, kick people off the cap table because of that, 5 million limit. And we've also seen it be used by founders as a way to, they still maybe want to bring an investor with a really large check through WeFunder, but maybe that investor is really particular about having their own line on the cap table, or like is very particular about, being pulled out of the SPV for whatever, preference or reason. And so that's the second, less common, but still, present use case for that Reg D.
And do those accredited investors still sort of come in through a WeFunder process?
Yes.
Or
yes, exactly.
So there's no accredited investors outside. It might not be a CF, but once you've started the CF, you're on the platform and everything funnels through to make sure you've got an eye and the lawyers have the eye on how everything is going.
Exactly. Everything happens through the same process, same platform. Just if you're an accredited investor, we'll ask for verification of your accreditation with like very simple documents. But otherwise, everybody goes through the same process.
Excellent. Now, Paul, I've been keeping tally of every time Mariel used the word simple or easy, but maybe you can, now I don't want to put me and Paul out of business.
Right.
Maybe you can talk a little bit about the role of outside counsel in the process here.
Sure. And one of the things that we can sort of mention right at the start is the definition of accredited investor has actually expanded since last year. It was just sort of a straight financial marker, and it has expanded to sophistication. So that has allowed more people, and it's kind of expanded the number of zip codes that have accredited investors a little bit. And so there's probably some more work there to be done, but the accredited investor definition is expanding, and I think that's a good thing.
I'll just jump in, Paul, and note that not only did the SEC, take a step forward sort of in terms of the financial pieces of the definition, but they also took a step into the year 2020 by saying that you didn't just sort of count things with your husband and wife, but they picked up other types of partners that might be living together in a legal relationship. So good for the SEC. But go ahead.
Sometimes the SEC has to be dragged along sometimes, but yeah, so Gary engaged us, just to give one example, and there are ways that outside legal counsel can guide issuers through a regulation crowdfunding process, not only from the beginning, sort of as strategy, as we talked about sort of in the planning stage. What do you really need to do to make this successful, as far as what I call your ambassadors, your people that really believe in you, believe in the company? How can they help you? What are the financial benchmarks that you're looking for, and all of that? But then also, once you get into start doing the legal documents, there are specific things with, especially risks are things that lawyers take a lot of time on, that should really be industry specific, and specific to the company. There are other things in the financial instrument, even if it's a sort of a, you have a template for a safe or a template for a convertible note that can make it a little bit more founder friendly. There are also things that will come up during the raise, and this is, I think, a really important thing, where potential investors will ask the CEO questions. They will have that ability, and this is a really cool thing about Reg CF, is that you have that sort of ability to interact. The investors have the ability to interact with management before they even make a decision there, and that all happens online. And a lot of times I will get emailed sort of, hey, I got this question from a potential investor. It's a legal question, or it's a securities question, or it's something like that. Just give me a draft answer for that, instead of something that's specific to the business. There's also communication rules, right? That we talked about testing the waters, and it has greatly expanded, and there's a lot more freedom to do things now than obviously there was before March. But there are things that you shouldn't be saying outside the platform. There are ways to there are disclaimers that you need, and all of that can be sort of, that's another thing that I get is sort of copy for, okay, we want to send this out to the email list, or we want to send out this advertisement. Look it over first, please. And so we do all of that. And just to put a plug in for our own package here, we do all of that sort of as a flat fee throughout the whole raise. So there is never a moment when there is a legal question or a question about the raise that needs to be had that doesn't get answered right away. And that's really a peace of mind aspect for a founder who may be new to this and may be new to capital raising, and you're doing a 6-7 figure securities raise. That's where we come in and we help them sort of smooth this whole process along.
That's terrific. I know we've got about 90 seconds left. That's when SEMA shows up on the screen. And I have one more question for Paul, but if anybody else has a question they want me to try to get in, please pop it into the chat box. So Paul, after Gary's, taken in his last dollar and closed his round, does he wave arrivederci to WeFunder? What happens next? I know with my public company clients, they have 10Ks, they have 10Qs, they have proxy statements, they have 8Ks. They're always talking to the market, earnings call. How does that compare to somebody that's raised money from the public in WeFunder?
Well, it's a lot less, but there are still regulatory, things that you have to do to keep well with the government and not get a nasty knock on the door from the SEC. So there is an annual report that has to be filed, at least one, usually around 3, depending on how much assets you have, how many investors you have, and that is another thing that you should have a lawyer look at. But there are ongoing regulatory commitments, and you should keep in touch with your investors, and you can do that through certainly you can do that through WeFunder and the other platforms, to let them know how everything's going. And then once you're ready for that exit strategy, and hopefully everything's worked out, then you can convert those people into common or voting shares, with an IPO or a merger or something like that.